All right, despite the government being shut down, the Federal Reserve is expected to cut interest rates by a quarter percentage point today. Countywide mortgage lending president Robert B. Hick joined us a little while ago to discuss how this will impact the lives of everyday Americans.
Right now, with interest rates coming down, this is the second one in a series. We're expecting, after today, 3 more. Every 6 weeks, the Federal Reserve meets, and as they continue to cut interest rates, it's going to help mortgages, car loans, credit cards, home equity loans, student loans. So it's going to
marginally, though. I mean, it's not big jumps, but slowly.
Over time, it could be a full percentage point less, which on the size of debt is a lot of money. Businesses are starting to thin. Normally, this time of year, we'd be hiring holiday help.
Right.
And we're starting to actually see businesses cut. So the Fed doesn't need its government data that it's not getting right now. It's just looking at what large businesses are doing, in my opinion, and they're starting to cut. So they really need to get ahead of this thing. They're behind the curve.
Meanwhile, many federal employees have seen their paychecks stop coming in due to the government shutdown. Chase Wilsey joins us now to discuss this in greater detail and about the importance of having an emergency plan. It's essential to combat these kinds of situations. Good morning to you, Chase. Welcome back to the big show.
Good morning. Thanks for having me.
All right. Explain to me the difference in your view between an emergency fund and an emergency plan.
Yeah, and I think the government shutdown has kind of done a great job shining a light, obviously, on difficult situations, right? You need to have a plan when layoffs occur, and they happen more frequently, obviously, I'm going to say in the private sector. So this impacts not just people going through this government shutdown right now, but also people that could lose their job due to a layoff. But when you look at an emergency plan versus an emergency fund, what I'm talking about is I'd say an emergency fund is maybe step 1 of that emergency plan. And what I mean by that is, yeah, you should have some liquid savings, but liquid savings alone might not be enough to get you through the difficulties of losing that job. So coming up with a foolproof plan and different steps to get through those difficult time periods is going to be, I'm going to say, the most effective way to deal with tragedy.
Well, it seems to be then alternate sources of revenue would be part of that plan. I mean, if you're working around the clock at your one job, how do you have another stream of revenue?
Well, and what it really comes down to is, yeah, I mean, the nice thing is in today's economy, I mean, if you lose your job, maybe you drive for Lyft or Uber, but really what I'm talking about is looking at utilizing your different assets, using different liabilities in the case of you losing that stream of income. And this is going to sound crazy, so bear with me for a second. But one of the first things you want to look at is your credit card and accruing spending on that credit card.
Explain to me how that works.
What I mean by this is a great example is this government shutdown. If you get laid off and you know you're going to get your job back and you know you're going to get back pay, using that credit card, if you just pay off that statement balance, you're not going to charge any interest on that credit card. So you could have close to about 2 months without any interest expense. Now you have to pay off that statement balance, but let's say your statement balance ends today, and then you charge that credit card tomorrow, next week, the following week. You don't really have to pay for those transactions until your next statement balance is due. So that is a very temporary solution to a temporary layoff. Do not use credit cards if you get laid off and there's no plan to repay them, because that is where you start to have that interest rate accrue, and that's a terrible plan. But credit cards are a great tool in a short-term layoff situation.
So what is that, a 60-day window then you have, or a 30-day window?
It depends
45?
on that. It depends on that closing balance and when that statement is due, but I'd say about close to 2 months is how far it can be pushed, essentially.
What else can we do?
Yeah, the big thing I always tell people is look at various credit lines as well. The big one that I look at is if you own a home, look at setting up a HELOC or a home equity line of credit. If you have a stock portfolio, open what I call an S block or a securities-backed line of credit. And you want to open these before that layoff ensues. Reason being is if you have no income coming in, the bank might not lend to you. So if you establish these, and there's banks that'll do this, you know, essentially for free, there's no expenses associated with setting it up. The only time you get charged is if you pull money out of that credit line. But again, if you only have that for, let's say, 30 days, 60 days, let's say it's at a 6% interest rate, annualize, that's not going to cost you too much in terms of that interest expense.
So you're talking, then this conversation is specifically for people who know that they're going to get back into the game as soon as the politicians get their act together.
get back in the game. And I mean, also too, if you do lose your job, there are going to be ways, I would hope after 60 days, that you can at least think of some way to start generating income if you did lose that job. Many times that comes with severance. So there are going to be different ways to kind of calculate that. You shouldn't hopefully be unemployed for 6 months. Unemployment should be a temporary problem, and especially you get unemployment benefits. So you got to really factor in all those cash flows that come in, and then utilizing your debts and assets in the most efficient manner. Too often I see people that have too much in cash. And again, it's nice, I'm going to say, if you go through this, if you have like, say, $100,000 in cash, you get unemployed, yeah, you just pull on that, that's good. But the problem is long term, you could be costing yourself, because as I said, if you hit that HELOC for 7% for 60 days, let's say, that's not too much of an interest expense, but you cost yourself not investing $100,000, let's say for 5, 7, 10 years, and you really cost yourself in the long term. So an emergency plan is really beneficial to your long-term success.
All right, Chase, we have to call it a conversation there. Thanks for rolling in.
Thanks for having me.
Look into that S block right after we're done here. All right.